All right, everybody. Hey, welcome to our next Note Nation Top 40 tour as we roll into the Cream City of Milwaukee, Wisconsin. Excited to have you guys here. Encourage you all to ask questions as we dive into this city, the different opportunities, what we're seeing as far as economic. Whether you're joining us live here on Zoom, on Facebook, or catching the replay across our different channels, please feel free to ask questions and comment. Love to hear what you've got going on, so that we can actually answer those questions on an ongoing basis. We do a really good job about following up. And so if you've got a question, we want to hear it as we rock into it. But anyway, guys and gals, welcome to the Note Nation. 42, this marks the 25th market out of 40 that we've hit. And really excited at what the opportunities that we're seeing out there. I'm using this also as a learning opportunity to learn about different markets that I can be looking at, investing in, and also some statistics as I come across other deals in the market. So we do have a variety of not only local to Milwaukee, but investors from across the country investing in the Cream City. You can always go to notenationtop40.com to check out the replays of our past cities, along with catching the tour schedule as we roll through America. We'll be discussing statistics and numbers tonight about Milwaukee. We'll talk about the second half outlook. We'll also dive into where the future opportunities are, where to find those, and how to tap into those tonight. So, again, everybody, my name is Scott Carson. I'm the host of the Note Closer Show podcast, a very popular podcast out there that you can download and listen to it anywhere you get podcasts out there. But I've been an active real estate investor since 2002, almost 20 years, 16 plus years in the finance, mortgage, and debt markets out there. I've bought over $500 million in debt for my own portfolio and helped others buy over $1 billion. As I said, I'm the CEO of WeCloseNotes.com as well. You can check out our website there for opportunities, trainings, and other things that we offer up there. But I've been teaching investors how to tap into distressed assets since 2004. I mentioned part of the podcast. I invest all across the country, even though Austin, Texas is home. And I have owned notes up in Milwaukee, in Wisconsin. I was born originally in Minnesota, across the border there in Rochester. So got a little bit of ice in my blood for the North out there. But I think you guys will guarantee that there'll be some great stuff here for you guys to use. So our mission has always been to help investors to accomplish their goals and dreams, increase their wealth through debt investing. A lot of opportunities. I was very fortunate enough over a decade ago to dive into the market in 2008, 9, and 10 and ride that wave. And I believe what's going on right now is another huge opportunity out there. So people have asked me, why am I doing this? Why am I spending time over 5 weeks of focusing on 40 markets? It's for a couple of reasons. One, I want to lose my voice, which I'm in the process of doing. But I'm here I love helping investors. I love helping identify opportunities, cities that they may not have thought of. Love working with people to solve problems, not just investors, but also working with borrowers. Because at one point, I was once a distressed borrower out there struggling, and I empathize with Americans that are living in a nightmare right now, being laid off or out of work, having a forbearance, not knowing how or when to pay rent. I do believe what's going on right now is an opportunity, though, for many Americans. It's definitely an opportunity to help, make America great again, one default to borrow at a time. I like to joke a little bit, but in all honesty, it's really up to investors, I think, to really make the best and turn a lot of lemons into lemonade out there as well. So there's nothing greater than helping someone overcome an obstacle or achieve a goal or dream that they thought was once impossible. A lot of people struggling, a lot of opportunities for us to help people out there that are struggling to make things happen. And I've set a goal for myself over the next 12 months to help over 1,000 investors tap into what's going on in this market and taking the opportunities provided to us with this COVID and pandemic and really turn into a win-win scenario. So anyway, where are the opportunities? Right there, everywhere, everybody. And I don't care what type of focus it is, whether you're looking for self-storage or apartments, single-family homes, you're looking for mobile home parks, office space, commercial properties, hotel, motels, so many opportunities out there. And the biggest thing I can tell you, if you're sitting at home and watching this or watching the replay or listening to this, is that what's going on right now does not care the color of your skin, the age, whether you're guy, female, somewhere in between, however old you are, whether you've got no hair or you've got a lot of gray hair, if you've been a successful business owner or a failing business owner, had struggles in the past, whatever, it doesn't matter. The opportunities that are available right now are so evenly set up that if you know what to do or you are coachable, and can follow instruction and do some of the important things that are available out there to do to tap in this asset, you can accomplish so many amazing things out here. Whatever your goal is, whatever your long-term future goal is, there are so many things and things that you can be doing out there. And like I said, I don't care if you are looking to retire, you're drinking more pina coladas or margaritas on the beach somewhere. If you're looking to retire your spouse, if you're looking to put your kids through college and help them graduate, maybe you want to retire your parents that are working too hard, still working as they get older. We know we've got an aging group of people that are struggling in the workforce. Maybe you want to travel more with your friends and families, or maybe you just want to buy some more toys or upgrade your current situation. You all know two things. One, it takes money to make money on that. But the beautiful thing with what's going on in the market, there are opportunities to be able to make this happen, to make money without you having to use your own credit or even your own funds. And we'll get to that tonight on how that opportunity is really a great one if you're willing to, roll up your sleeves and get to work. This is not a get rich quick thing. It's like building wealth, building investments, and you've got to be willing to, like I said, put in some time to really take advantage of the opportunities that are presented to us out there. So what do the national numbers tell us? They tell us a lot of things, that there's a lot of people hurting. One, when you look at that, there's 11% employment rate since in June's numbers. July's numbers are not, they should be released any day now. But 1 out of 9 Americans is unemployed. When you look at the fact that there's over 40 million people collecting unemployment out there, ouch. When you look at a big bunch of small businesses, over 52% of small businesses are expected to fail and not recover. And that number gets worse every day, depending on what happens in the city or the state that you're in. Before everything happened, we were already struggling. 1 in 10 homeowners were already struggling to stay current in their stay current in their mortgage. That's been going on for a while out there. Some people don't believe me when I tell them that, but yes, 1 out of 10 Americans is already struggling to stay on time, was already 30 days late on their mortgage out there. Now, currently, we're at a 7.76% national default rate. That means that they're at least 1 out of every 12 borrowers is at least 90 days behind in their mortgage. That number is going to go higher, okay? Currently, 4.1 million Americans are currently in default, where they owe at least 90 days or more. When you look at a couple other things, in 2008, it took us 18 months to hit that $1.6 million mortgage default mark. We're 2.5 times that, 3 times faster, okay? And the thing you gotta keep in mind out there is it's all across the board. We have non-prime or the subprime loans that are defaulting at record rates. You're seeing reperforming. You're seeing a variety of things happening out there. Lenders are literally bracing to eventually see another 15 million homeowners upside down. Now, that was the peak in 2010. Do I think we'll hit 15 million? Not as long as the government keeps kicking the can down the road and doing mortgage forbearance agreements. I think it's a good thing to help Americans. All the government-backed stuff has automatically been extended 6 months. The government, Fannie, Freddie, Ginnie, all those Annies are probably going to be willing to extend it another 6 months for borrowers if they want to take it up there. So it's going to vary on what's going on. What's really going to be hurt is the non-government loans that people have, investors who have tenants that aren't paying, and the banks at some point are going to want to start getting paid as well. So the housing hardship index is something that we should all look at because it varies on a state-by-state basis. This is something that takes into consideration the unemployment rate, the delinquency rate in specific states, and gives you basically a housing index. Now, Wisconsin ranks not so bad. Unemployment average across the state is 8.5%, which is good. That's less than the actual national unemployment rate. The delinquency rate is an amazing whopping 5.55%, which is quite a bit lower. Good 35% lower than the national average. That's a good thing. Obviously, that puts Wisconsin with those two ranks number 40th nationally, which is not as good. You don't want to be number 1 in the housing hardship index out there. So that's a good sign. It's a good sign for Wisconsin's. All right. Definitely not bad at all. But when you start looking at the economy at a glance by pulling up the Bureau of Labor Statistics out there, you can see Wisconsin across the board, 8.5% unemployment rate for June. July's numbers should be out relatively soon for the most part. When you look at Milwaukee, though, does have a higher percentage. It peaked at 13.6 in April, came down a little bit in May, came down to an even 10% in June. So Milwaukee's being hit harder than other parts of Wisconsin out there. Now, if you look at the bigger areas, this might be a little bit blurry to you, but you can see Milwaukee has the highest unemployment rate of most of the major cities. When you look at Appleton at 7.5, Eau Claire 8.3, Fond du Lac 8.3, Green Bay 8.6, Janesville, Beloit 9.7, okay? Racine 9.3, Oshkosh 7.7, Wausau 6.9. You can see, why is that? Well, obviously a big chunk of this is the tourism industry. It's the hotel staffs in the bigger cities. Those people have been laid off, the restaurants, the bars. They're not going back to work. Those are the ones that have been hit the hardest. And I think we'll see definitely improvement for July's numbers. Hopefully they're out next week. But still a lot of people struggling to make ends meet, to make things happen. Now, when you look at what happens if people can't pay their bills because of the fact that they're not working or unemployed, we start seeing an increase in foreclosures out there. Now, if you're looking at Milwaukee, 1 out of every 10,649 homes is in default. Obviously, the lower default rate of 5.55% is great, but you still have the difference between the haves and the have-nots. You still have some zip codes that are being hit a little bit higher, like the 53225 zip code, 1 in every 3,500 homes. The next one up there is basically 53218, 1 in every 7,700 homes is in default. I'm sorry, facing foreclosure. Now, looking at the number there, you can see over a month, auctions are pretty much 0%, haven't really adjusted much. Prior month bank owns are down because the foreclosures were down. You can see that those numbers have dropped basically when everything went south back in middle of February, and things have not really seen a big increase. You've seen a few things happen that were not COVID related. Bars that were late already in the foreclosure process before everything happened, and those things have kind of still proceeded a little bit. Foreclosure numbers have dropped off the books, and the foreclosure market in Wisconsin is actually quite a bit lower than the 0.01% that is national-wise. Black Knight checks the mortgage delinquencies, a huge company that runs a lot of things through the Mortgage Bankers Association. Says we saw a big increase, 50% increase in defaults across the country over the past 2 months. We'll probably continue to see that in parts of Wisconsin, probably more in Milwaukee than in other places. Currently, we're, like I said, at 7.76 with roughly 4.1 million borrowers that are 30 days or more past due, but not in foreclosure yet. So we have roughly a big chunk of defaults. All right, 4.1. We had another 4.1, 4.2 million in the pipeline coming down behind it. Now, this map is kind of a hot map talking about which states have suspended foreclosures and evictions with statewide moratoriums, or they've done local, or they have resumed. You can see in the lighter green, Wisconsin up there, states where evictions have resumed out there. Moratoriums on evictions and foreclosures issued by Governor Tony Evans expired on May 26th, allowing landlords and banks begin evictions and foreclosure proceedings. And they were up 26% year over year in Milwaukee alone in June. But of course, President Trump just issued another stay here for the next 60 days. He issued this just a couple of days ago, stating basically that the Fannie and Freddie have extended the foreclosure suspension on the government loans for at least another 60 days through at least August 31st. That's a good thing. Wisconsin's kind of getting slow. It's not really starting off too fast. It's only a 1% of what it used to be when it comes to the foreclosure auctions out there. So something to keep in mind out there. Now, are we going to see a big amount of foreclosures taking place? Are the dominoes falling with unprecedented job losses, defaults? And yes, we're going to see that, but it's going to take a while to hit. It's not going to be anytime soon, but what are you going to see when it comes about? Well, when you look at the types of loans that are defaulting, it kind of breaks down to really a lot of your first-time home buyers. We talked, if you look at Realty Tracks numbers, it's that $200,000 value or less. That is the biggest amount of foreclosures and defaults. The FHA loans are roughly 1 out of 10 of those borrowers are in default. Seriously, because why? Well, FHA buyers or a homeowner who gets an FHA loan is only have to put 3.5% down. A lot of banks are donating that down payment, plus also throwing in some closing costs. Bank of America being one of those. Lending programs, oh yeah, we'll give you the 3.5% down. Oh yeah, we'll cover your closing costs. Some people could show up with nothing out of pocket and buy a house, okay? And if you look at the conventional loans, it's a much lower default rate of 3.16% because people, they got more skin in the game. They're gonna have more reserves. But your first-time home buyers are a lot of your entry people. They don't have a lot of savings, don't have a lot of reserves. The bartenders, the wait staff, the tourism, the hotels, your service industry staff. That's where a lot of your FHA buyers come from, and that's why a lot of that stuff is defaulted. And you've got second highest is the VAs, but then all the rest of the loans are throwing at roughly about 4.36%. So keep that in mind. Forbearance agreements numbers are across the board. They predict that we're still going to see roughly over 4 million defaults, forbearance agreements through the end of the year. Currently sitting somewhere between 4.5, 4.1 million borrowers. They also, economists also want to say that there's probably another 4 million borrowers out there who could be on forbearance agreements who haven't called their bank. They're too scared to do anything. They're just trying to pretend and extend, hopefully, or hide their head in the sands and hope that the banks don't call them on some things, okay? Now, is this good news or bad news? Well, the good news, we talked about this. Wisconsin, if you lived in Wisconsin, the lower default rate versus the national average, okay? But you guys do have a longer foreclosure time frames compared to some of the other states out there, with it being a judicial foreclosure state. For an FHA foreclosure, that's 540 days based on what the Fannie and Freddie and the FHA prescribes. That's over a year and a half to foreclose if you've got an FHA loan. Now, if you figure in there's a 6-month or 12-month forbearance agreement, we know you're going to see a lot of stuff get dragged out. You add in the high property taxes that Wisconsin has, that can be another whole wave of defaults. I don't think the governments are going to be exceedingly aggressive on that, but I think you're going to see an increased amount of property and tax sales out there. That's another way I'm thinking. You can't pay your mortgage, you're not paying your taxes. We all know that, okay? You got in the backlog of forbearance agreements, and those investors that have gotten all excited think we're going to see a wave of foreclosures in the near future, they're going to be waiting 12 to 18 months before a lot of foreclosures hit the market. And maybe they get gobbled up by other banks, other institutions, or other investors like you and me out there. There will be some opportunity, but it's not going to come the route of buying the actual real estate of the property. It's going to come in a variety of other fashions. We'll get to that. Now, what about the commercial markets? Okay. The commercial markets have been hit harder, I think, more so than the residential markets. It's not easy to find out the exact default rate of a lot of commercial loans, but you are seeing it when you drive around town. You see the amount of increased rent signs or for lease or boarded up businesses shut down, restaurants closing. Like we talked about before, 52% of small business will fail. That number gets worse the further out this thing rolls. Commercial real estate has been in a boom, and a lot of people say, hey, it's been overpriced for roughly the last 12 or 24 months. Even hedge fund guys have said that. I've been saying that because I'm like, you can't be selling apartments at the peak of what they are right now. This overpriced commercial stuff, it's end. Hey, it's over. The commercial boom is over across the country. It's going to take a good 24 to 48 months, 2 to 4 years, for the specific markets, specific asset classes to kind of get back to where they were beforehand. Now, when you look at the asset class default rates across the board, this is through June of the asset class. Now, of course, you see hotels, lodgings, really a big chunk of them, 30 days delinquent, 30 to 60 days in the blue, 60 to 90 days in yellow, 90 plus days delinquent, and then the red in the foreclosure REO side, because they're not starting this. A lot of your banks are trying to figure out ways to keep the borrowers in place without having to take the property back. Last thing they want to do is a wave of commercial foreclosures that depress the market even further. Okay. Now, the market values in commercial asset classes across all boards are taking a hit. Yes, even apartments, student housing. Really, the only thing that hasn't has been the senior housing is the lowest rates out there for the most part. But when you start looking at how big some of the different markets out there, you look at the top 15 U.S. metropolitan markets, they're anyway from 500 to over several $1 billion in distressed debt out there. Now, Milwaukee's got its fair share. If you look across the state line to Minneapolis, there's $2 billion in distressed debt. You look south of you guys in Chicago, $2 billion. Milwaukee's going to have somewhere in that $1 billion, $1.5 billion aspect of things and defaults out there across the board. Now, looking at the asset classes is struggling the worst. Obviously, we talked about hotels. 1 in 4 hotel loans are in serious default, and we see that in Milwaukee. Okay, when you got your hotels that are closing down, nobody's coming in to watch the Bucks play. You look down to Green Bay, and probably not many people be flying in Milwaukee to drive to Green Bay to watch the Packers. You look at Wisconsin football with a Big Ten, shutting down. It's going to continue to struggle a lot of places out there. event staff, hotel staff are really going to be struggling out there as well. You look at retail. When people come to town, they look to buy some stuff. Well, retail's struggling, has been struggling for quite a while. They're expecting 1 out of every 2 malls to fail out there. 1 every 5 or more retail loans are in serious default. Office vacancy is set to increase to roughly about 20% nationwide. This is one thing that's definitely impacting Milwaukee on that aspect of things. Now, you also look at vacancy factors in restaurants and retail spaces are going to continue to increase as well to 15 to 20% vacant across the board. Rents are dropping 10.5 to 12% by year end. That number will continue to decline moving into the new year. Okay, that's a tough pill to swallow because you have to expect if you're a landlord, a commercial property owner, and you've got vacant spots, you're going to expect to maybe only get 85 cents on the dollar of rent of what you were getting. And you also expect it to take a little bit longer to fill that occupancy. You've got to get creative in either pivoting the asset to something that is very much so needed or expecting to hang on to that asset and try to work out some favorable terms with your bank. Now, that's the thing. A lot of this stuff has been financed by the banks. We'll get to that in a second. But decline, it's going to continue into the next year, especially depending on how things react here in the fourth quarter. Now, we all know that a lot of the banks, a lot of the commercial mortgage-backed security guys have really taken it rough. Over $50 billion lost in March on the CMBS markets. They were a bigger contributor to the finance of the commercial assets back a decade ago. But what's happened right now is a lot of the banks, your banks have gotten greedy. So them financing a partial amount of what happened over a decade ago, they've gotten into actually have the lion's share. 53% of the distressed loans that are out there right now, okay, are financed by your banks. Okay, now you got to realize it's just the tip of the iceberg with what's going on in the commercial markets. We are going to see a huge wave, tidal wave of stuff hit sooner than we see on the residential side. Now, talking with my commercial investing guys, the platforms I look at, my contacts on Wall Street, they're all saying they're starting to see more deals now in the last few months than they saw all the last 2 years. Better pricing, better deal flow than they've seen in a while. And they've been licking their chops for a while waiting for this to happen. But it's going to get worse. And why is it going to get worse, and how can you guys capitalize on it? Well, I'll tell you right now. When a bank, not a CMBS guy who gets cheap money with leverage from Wall Street, but when a bank finances a commercial property, they're going to look at somewhere between 60 to 70 cents of as-is value. Now, we talked about rents decreasing, vacancy increasing, all right? Rents decreasing, while vacancy decreasing. That's going to reduce your net operating income, which reduces your value, reduces your cap rates across the board, especially if you're in a distressed asset class, okay? If a bank finances you at 70%, and your values drop 20%, that now means they're at 80, 85% of LTV. The banks don't like that. Even if you're paying on time, the bank is not going to like that. They're going to go to their borrowers and require a capital call. You got to bring 15, 20% cash to pay down your loan to get to that 70%. Otherwise, you're in default and we'll start the foreclosure process. Already seeing it. I've had several banks in Wisconsin actually reaching out to me, Citizens Bank, to be reaching out to me talking about borrowers they've had on the books in some banks for 50 years that they're looking to get rid of. 50 years a borrower relationship, and they're looking to move off because the guy's just defaulting. It's on a resort on the lake on some of this stuff. It's just ridiculous. In the banks, this is the stuff that's clogging up their arteries, okay? Worse than my grandma's fried chicken, okay? Or the fact that my grandfather ate bacon and eggs every day for like 80 years, clogged up his arteries and finally killed him off. The banks are struggling right now, and they're running scared. You don't see a lot of stuff. You hear about the forbearance, the unemployment, the COVID numbers, yada, yada, yada. It's a lot of misdirection out there, okay? Now, what do you do with this stuff? Well, you step in with cash and either A, buy out some of the bad loans, take them over yourself at a big discount, or work with the current borrowers to try to reposition the property in a variety of ways, okay? It's going to get ugly. Banks stand to lose at least probably $48 billion in the commercial real estate market. Ridiculous across the board. Bank of America came out just a few days ago, announced they're expecting to lose billions of dollars along with Wells Fargo, American Express, and some of the other companies out there. With Bank of America's share roughly going to be $5 billion plus in losses. $5 billion plus in losses out there, ladies and gentlemen, by the bell cow of the banking industry. It's 2008. It's the Big Short all over again. You just got to know how to operate and where to look at to find these deals. Now, are you going to call Bank of America to buy a one-off residential note? No. Are you going to call their commercial side, maybe buy a commercial note? Yeah, you might be able to, but where the opportunities lie in this, and let's clarify this real fast. Is it going to be in the foreclosure REO market? No, it's not going to be in the foreclosure market or REO market on the commercial or the residential side. It's just not going to be that. That's 12 to 18 to 24 months out. The residential side, it's not going to be in the foreclosure side when it comes to buying the real estate on commercial properties either. It's not going to be in the fix and flip side. You don't want to do that. Banks aren't going to be lending on for you to buy fix and flips. Hard money lenders have pulled back in a lot of cases out there. They've reduced their loan amounts, loan percentage, and increased their requirements. Okay, rentals. I would not want to be in the rental market right now. If you can get delayed again and again and again in different parts of the country, I would not be on the rental market. The real opportunities lie in the debt game, ladies and gentlemen. That's where you buy the note, become the bank, and you work out something with the homeowner. You work something out with the property owner, the owner-operator, because the fact that you buy that debt at a substantial discount, ladies and gentlemen. We're going to see a lot of stuff start hitting in the fourth quarter. Why the fourth quarter? Because of the fact of two things. You're probably not going to see a lot of government-backed stuff in the fourth quarter. What you're going to see is that non-government insured stuff, the stuff that's been originated, your second homes, your investment style loans on the residential side, because the banks, by the time the fourth quarter hit, would have about 6 months to evaluate their portfolio and look at every one of their borrowers and be able to identify those that have, okay, those that are operating, we'll keep. Those that are in trouble, let's kick the can to somebody else after we've kicked it down the road for 6 months. So you can see that on the residential side. You're going to see already on the commercial side. We talked about this a minute ago. I was just talking with my buddy Mike Jimenez from Exchange Loans, talking about they've gotten more commercial portfolios and residential note portfolios sent to them in the last 90 days than they could ever imagine. They are swamped with stuff coming in from their banks, their connections. Auction.com, 10X, also swamped with a lot of distressed debt and portfolios and assets out there from the banks that are looking to get this stuff off their books. Now, to be creative, you're going to have to get creative on this. If you're, like this guy who has a hotel's not one of the things you want to own right now if it's vacant and nobody's traveling. We flew to Charlotte last weekend, and the hotel we stayed at had just opened up a few weeks ago. It had been closed for 60 to 90 days. Okay? Get creative, just like this guy did by taking his hotel and turning it into apartment complexes and selling it off apartments. Our buddy Garrison Gilbert is doing this in Pennsylvania. He's out of Baltimore, finding smaller hotels, the non-chained or the mom pops open, finding the bank on those, and either taking the asset over and converting it, buying the debt, and then getting flexible with the existing property owners. We've looked at this asset here in downtown Denver, office space. Horrible vacancy, a huge vacancy factor on new builds and stuff like that. Luckily, the owner-operator converted this to basically a self-storage facility, doing well, and pivoted where it was needed. So if you can get creative on the asset that you see, and creative on what the bank has looking to get rid of, you've got a lot of flexibility. I'll tell you right now, this asset right here, less than $1 million listed for sale right now. On the 55-unit hotel, roughly less than $1 million. So a lot of opportunities there to make some really great things happen and create a lot of win-win and some really sweet tasting lemonade. The biggest opportunities aren't going to be in that $5 million big, huge asset class. Wall Street that's got cheap money is going to come gobble that stuff up. Biggest opportunity lies in that small $2.5 million value, $2.5 million loans or less that the banks have financed. Every bank has it. On all the averages that we see roughly across the board, it's 25 to 30% defaults on the commercials, on the residential side, and 60 to 70% on the 25% to 30% on the residential, 75% on the commercial side of things. Wisconsin, hey, it's the same. It's got some banks in trouble up there. Now, one of the things that we track on a quarterly basis, we tap into Bauer Financial. Bauer Financial is a third-party independent company that evaluates banks, credit unions, lending institutions across the board, and they ranks them on a 0-star to 5-star level. It shares their information that they follow the FDIC, whether you're one bank all the way up to 5,000 branches like Bank of America. Now, what we do is we narrow the list down a little bit. We look at banks that have at least 5 branches or more We don't waste our time with the credit unions, but just the main banks, the FDIC stuff. And it gives us numbers on their default rates, how much in default debt they have on 90 days, plus 30 to 89 days, commercial, multifamily, what percentage of their portfolio is in default across the board. Now, there are a lot of banks of offices that are, there's thousands of banks that are lending in Wisconsin. We know that, okay? A lot of banks all across the board. But if you look at the list of roughly about 3,000 banks that we pull from Bauer Financial, 80 of those banks are based with their main office in Wisconsin, okay? We know there's more than 80 banks lending there, but if we just take a snapshot of those that call Wisconsin home, okay? Those 80 banks have a combined roughly $515 million in 90-plus day defaults and an additional $300+ million in 30 to 89 day defaults as of June. Now, what's that mean? July, August, we get to September, those 30 to 89 days are going to roll into that 90+. So you're looking at somewhere between $500 million and $1 billion roughly in distressed debt. Across the board, it's about 6.42% of each bank's loans are 90 days past due on an average basis. And out of that, roughly 25%, $126 million is in single family loans. The rest are in commercial loans, okay? Now, two of the biggest contributors who have the biggest amount of their portfolios in default, People's State Bank has a whopping 32.5% of their portfolio in default. They're not ranked a 5-star, they're ranked a 3.5-star, okay? Now, Jackson County Bank has 25% of its portfolio in default of 90+ days, and they're a 2-star ranking, okay? 2.5-star ranking. That's not good. You want to be a 5-star bank. That means there's a lot of opportunities across the board. Those would be the first two places I would reach out to see what they have in their books that I could take a look at. Now, why would I want to buy that distressed debt? People ask me all that all the time. Why would I invest in distressed notes? Because of a couple things. One, you have a lot of power as the bank. Two, you have a lot of flexibility, and you're also going to see amazing deals being close to the source. All right? You can start purchasing that debt now and start doing deals now to get creative, take advantage of the opportunities versus waiting around for 12 to 24 months. I've talked to so many investors out there and realtors like, oh, I'm so excited for this foreclosure wave. I'm like, well, you might as well take a long vacation because you may not see a chunk of it. You may not see even a fraction of what's going out there because the stuff's going to be worked out by other institutions. And that's the beauty, guys and gals, no matter where you're at, what your experience is, age, what you have in the account, what you don't have, background, there is an opportunity to step in and become the bank in so many ways out there right now. By the fact that you can buy this debt at significant discounts, depending on the location, the foreclosure time frame, the values, condition, et cetera. I'll give you an example. New York City, okay? Most expensive real estate really in the country out there. 1,300 room hotel off of Central Park, $260 million loan that the bank is looking just to get roughly 18 cents on the dollar. 18 cents on the dollar for a hotel, 1,300 rooms, selling for roughly $50 million on a 260. That's crazy, everybody. And if you don't think that type of stuff is gonna shift down to everywhere, including Wisconsin, including Madison, including Austin, Texas, LA, you are wrong. That will be, everybody, okay? You can purchase this debt and then turn around and control the asset because you've got a lot of flexibility by buying that debt at a huge discount, all right? You've got a strategies of loan, reinstatement, modification, short sale, payoffs, foreclosures, loan sale to somebody else, deed loan, cash for keys. So many different exit strategies on both the residential and the commercial side. Take over the note and turn it into the cash flow with a performing note or working with the borrowers in place. Or, hey, offer some cash to walk, deed in lieu, friendly foreclosure, let them move on their way, and then you keep the asset if you want to. All right? Other advantages of note investing. This is one of the biggest things that attracted me as a note investor. And it attracts a lot of people out there are trying to dive into real estate investing on shoestring budgets. They don't have much. They're bootstrapped to make things happen. And we don't waste thousands of dollars each month in direct mail. That's a waste of money. We don't mail postcards, yellow letters. No offense to those that are doing that, but it's the 21st century, everybody. People get tired of getting postcards. They're already getting letters. They're not opening their mail. I don't want to deal with a one-off asset. I want to use smart tools like emails, LinkedIn, or pick up the phone and dial for dollars to call the banks that I know that are in trouble that I can track on a regular basis to make things happen. And one source, like Citizens Bank, one source Lexington Novus Bank leads to thousands of regular deal flow on a regular basis. Not just one asset, but properties and notes on a regular basis that I don't have to go out and drop more and more marketing on to rinse and repeat. And you get a listing, you cherry pick the best deals for your portfolio. Pick the best, get rid of the rest. All right? If you want to buy in bulk, guess what? Better pricing when you buy in bulk, because the banks aren't worried about you buying their whole portfolio. They're more worried about you just buying something now. Please buy something is what we're hearing and seeing out there, okay? On both residential and commercial assets now. You're not going to buy a one-off like a note from Bank of America, Chase City. It's not worth them to do that. But it is. A lot of times you'll see that in the regional banks, the smaller banks, that aren't the huge top 5 or 10. They've got stuff in their books they got to get rid of, okay? And look, I don't care if you don't have any money. When I started doing this, I didn't have any of my own money. I just go out and raise money from other people to fund these deals, or turn around and wholesale these assets and made a quick buck for marketing, putting investors together with the deal flow. And that's a great thing you can do. There's so many investors out there that want to do some things. Guys and gals, if you think about that, there was 15 million homeowners in 2010, and they're expecting us to see that. Big question I ask you is, how big a piece of that pie do you want? My biggest regret is I didn't buy more when I knew what I know now, okay? Well, I know what I know now, and I know what happened in the past, and I see history repeating itself. It may be dragged out a little bit longer. You may see some advantages with the government delaying things, but the debt isn't going to go away, and there's opportunities if you know where and how to play, okay? Now, are there investors out there, people that when the biggest things like, well, this sounds great, Scott. Yeah, I know the banks. Okay, great. But I don't know any investors. I don't have my own funds. And when you look at the fact that there's $9 trillion in retirement funds sitting out there right now making nothing, and then you look at the numbers that's going on, let's just look in your local area where you can pull numbers, contact information, addresses, emails, phone numbers. There is a whopping amount of investors in Milwaukee alone. 16,000 investors with an IRA account, okay, with an IRA, individual retirement, 16,000. Out of 16, 11,000 of them have 150 grand or more. Hello? That's a lot of money. How many investors do you need to talk to take that deal down from the bank? The bank's going to give you some time to raise capital. They'll give you some time for due diligence. If you know and can talk to people, can network with people, can reach out to people, great, you can put some deals together. And if you don't want to take down the deal yourself, guess what? There's 14,000 plus real estate investors in the Milwaukee, Wisconsin area that call themselves that on their tax returns, 14,000. Find a deal, negotiate it, and flip it for a fee to somebody else to take it down if you're scared to raise capital. And you honestly shouldn't be, but just in case you are and you want to get your feet wet, guess what? Make a $5,000, $10,000, $20,000, $100,000 wholesale fee, whatever the deal will hold, as long as it makes sense out there for you. So the question I ask you guys, do you want to be the bank or the borrower? You want to be the banker. I'll tell you that right now. We're all in the paper game, everybody. Most of you have payments going out to your mortgage, your car payment, your student loans, Bubba down the road, okay? You're on the wrong side of the payment stream. You want to be the bank because the bank isn't in the rental game. The bank isn't in the short-term rental. They're not in the fix and flip game. The bank is in the note business. That's why the banks are big. That's why they understand leverage, compounding interest, and cash flow. And when you also add in the fact that there's a tremendous amount of people saving money now for a rainy day, people are a little scared and want to do something. Why not pick up an asset and really create a win-win scenario? Because the bank is always going to win. It's time that many of you need to jump on the winning team. Many of you need to elevate. You need to evolve into what's opportunities out there. An opportunity like this only comes around like once every 20, 30, 40 years. You look at the RTC days, the same as the loan scandals, and the amount of debt that happened there. Obviously, what happened a decade ago and what's going on right now, everybody, it's time to act. When there's blood in the water, that's the time that when everybody's running scared one way, you run the opposite way. Now is the time to start buying up debt, buying up assets at huge discounts, and ride this wave. Just surf the tsunami of deals out there. So how do you tap into these deals? Well, guys and gals, I've been teaching real estate investors how to buy distressed debt for over 10 years now. I've been buying it for over 12. I have funded over $500 million in debt for my own portfolio. I've helped thousands of real estate investors just like you all that are watching this or listening to this purchase their first non-performing note, whether it was a one-off deal or it was a performing note or a non-performing note. I've helped thousands out there, whether it was residential or commercial. We've got experience in both. And the beautiful thing is a lot of the same way when reaching out to these types of deals to find these assets, okay? If you're looking for cash flow, great. If you're looking for asset growth, you want to take some assets down to hold on to them, by all means, you can do that now too as well for you. Like I said, buying a one-off, buying a bulk, it does not matter. You can do a lot of this great stuff out there. And we've seen trades from 25 grand for a one-off deal all the way up to over $5 million for some high-end condos on San Diego Beach, okay? So many different opportunities out there for you if you just know where to look. And like I said before, bank doesn't care if you're in forbearance on your property. They don't care what your credit score is. They don't give a rat's ass. They don't even look at that. All they want to know is that you can fund, and it doesn't even have to be your own funds. They're not going to ask where the money comes from. If you've got an investor or a group of investors that you can work with, hey, now's the opportunity to really dive into this stuff. And you start doing deals, if you're coachable, by sending out emails, LinkedIn connections, or jump on the phone and talk with people. If you know what to say and what not to do, you got to be coachable to make this thing do. And we've been doing a great job with that. And like I said, whatever your focus is, whether, like I said, it's single family homes, apartments, hotels, retail office, self-storage, mobile home parks, there are deals across the board in all asset classes out there, ladies and gentlemen. And you can truly create win-win scenarios and stories, not only for yourself, but for the borrowers as well. Who doesn't like helping people stay in their houses if they can? Who doesn't like creating a win-win scenario? You know, whether it's single family homes or you're working on some higher end stuff, but you've got developers that need to walk away from, but you can pick up an asset really great, like this one in San Diego, or you can pick up some smaller apartments. I know apartments are hot. You're not going to see 500-unit apartment complexes in the fall. What you will see is a lot of smaller units, sub 100, sub 50, sub 28, like this one also in San Diego. We did pick up a 300-unit apartment complex in Indianapolis last time. We expect to see some of the bigger ones as people are over-leveraged or overstretched out. It's going to be some opportunity. Just got to know where you go. You never know what the bank is financing. We all know banks that are based in Wisconsin or have offices in Wisconsin just aren't lending there. They're often lending across multiple states, multiple markets, and multiple opportunities for you. So you can do this big or you can do it small. Most people start off small, and that's A-okay. You got to figure it out. It's a different mindset, different philosophy when it comes to buying debt than it does to buying a piece of property and fixing flipping it up, okay? It's not flip this house or flip or flop. It's a different mindset when it comes to it, and it takes a little bit of time. Our buddy Gene Chandler here out of Indiana was doing things very small, little fix and flips, using what little money he had at the point, take down an asset, try to sell it, and then roll that money into a new deal. And he can only do so much. He learned the note business from us. We mentored him. We spent some time with him. We got him rocking and rolling. Fast forward a couple of years later now from when we first met him a few years back, he's closed on over 135 deals. He's got about 13 to 14 million in private capital out in the markets and doing an amazing job. And retirement has a different destination than what it did beforehand. It's also a different dream for him and his wife, okay? Or it'd be like Laura Blunk out here. Normally from south of just Austin, she just moved to Maryland, moved into her dream house. When we met her a few years back ago, she was like many investors, going to the local real estate club, taking workshops, trying to put tools in the tool belt. Well, you know what? Take that tool belt and throw it across the room. You don't need it anymore. All right? In her first 18 months, she bought about 14 notes after spending some time learning it with us teaching her and holding her hand. Fast forward 4 years later, she's closed on over 100 deals and is getting ready to close on a portfolio of over 100 performing notes at 53 cents of value. Yeah, it's already basically an 18% cash and cash return, not to include all the equity. And she's doing that deal with other people's money. That's going to have a big impact on her future, her family, her boys, and her next generation to come. You also talk about Keith Collins getting a little bit older, the senior statesman of this group. Keith's got a lot of experience in real estate. I think he was a mayor of a small town, built developments, water treatment plants, lives outside of Cincinnati. Great guy, a lot of experience, but not a lot of experience in the note business. We taught him the note business, taught him what to do, what not to do, and absolutely took to it like a duck on water, okay? Sends me an email, says, Scott, it's been an amazing ride. We're going to make over 7 figures in 2019, which he did last year. He's expecting to do that again this year. and absolutely loves it. He's never going to retire like a lot of us. We keep doing what we do. We're in real estate. Isn't something that you retire from. It's something you always constantly do, and he's done an amazing job. Now, these guys all have great experience, like many of our students out there that we've helped. But if you're brand new, don't have a lot of experience, and a little nervous, like, oh, I don't want to be thrown out in the deep end and drown, don't worry. You'd be a lot like Raphael here. San Diego business owner, owned a car detailing business, 15 full-time employees, liked real estate, but didn't even own a home. Rented a place, didn't know a lot of the terminology of that. Started diving into the note business, read about it, took our training back in November. In the first 60 days, he bought 5 notes. 2 of those he used smaller deals, but he's making a 20% return on it because he got those 2 deals reperforming with the borrower. The other 3, 2 of them he's flipping, the other one he's keeping. And fortunate for him, notes have helped save him. With COVID and nobody driving, nobody wants to pay to get their car detailed by somebody else. So he delays his whole staff off, basically closes doors. He does not foresee opening back up in business, but he's not sweating because the fact is, A, he's got an opportunity. He sees it. He's coachable and taking advantage of that. He's also talking to his network around him. He's raised, I think, 100 to 150 grand in private capital to go out and buy more note deals. And he's doing a great job getting things started. Small, but everything big has small roots. It all starts with one step. It all starts with taking action. And we are so proud, not only of these 4 people, but the thousands of people that we have helped close deals and make a difference, not only in their lives, but in the lives of the community, the lives of the borrowers that they've bought and modified, and the lives of the investors that are helping out there. And we would love to add you to that group if you're watching or listening to this. Like we said, we've got a big goal of helping 1,000 investors tap into the markets that's going on right now to really make life-changing income, life-changing wealth for you guys out there. No matter what your goal is long-term, we want to help you do that. How do you do that? For many people, the first step is to take our Note Weekend training. Our Note Weekend is an online live training class with yours truly on a Saturday. Come spend a Saturday with a note guy as we go through the nuts and bolts, the basics of note investing. And our students love this. They say this is the best thing when it comes to note investing. I'm a no BS, not going to blow smoke up your ass. I'm going to tell you exactly like it is because I don't want to waste your time, and I sure as hell don't want to waste my time. I want to make sure that you're dangerous and that you have a knowledge when you walk out there, either to help yourself or be knowledgeable in the market out there. Like I said, it's a one-day online training, mini workshop. You're not going to learn everything about the note business in one day, but you learn a good knowledge base. Our students call this the Cliff Notes version of note investing. I'm happy with that. That's a good thing. Learn the higher end stuff and then figure out if this is something for you. Dip your toe in the water, dip your ankle in the water, and get rocking and rolling before you dive in. Okay. We live stream it via Zoom on a Saturday with the replays available on Sunday. Replays are included for those that are signed up. Normal price is $99. We've dropped the price down in half to $49. And we'll run from 9 a.m. to roughly 3 p.m. Central. We'll run to 5, 6, 7 o'clock at night too. Sometimes we do this usually, like I said, the third weekend of the month. If you go to noteweekend.com, you can get signed up. You'll see the register button. Click on that. It'll take you then to a checkout page. Discounts already applied. You get signed up for that. We'll get the replays out to our most recent class. You can start watching that now and be ready for the live class here in just a few days. Like I said, we do it about once a month, usually third weekend, sometimes the fourth weekend, depending on. Now, what are we going to cover? Well, we'll spend the first part of the day. Whoa, something went wrong there. First part of the day showing you how to find these deals. I'll actually literally show you where we build these lists, where we contact the banks. We'll show you how and what not to say, how and where to find the deals, which is an important thing. We'll also talk about the second part of the day, how to fund these deals. We'll show you how to find other people's money, other investors around you so you can tap into them to fund your deals. We'll then also talk about the different exit strategies because there's a variety of strategies in the note business that are different than your fix and flip side or your landlord. If you're tired of a lazy landlord or tired of toilet sitters and trash outs, guess what? Nobody calls the bank when the rubber ducky gets flushed down the toilet. They don't call the bank. They call the property manager, okay? We'll talk about the different exit strategies, how to make money with the debts on the residential and the commercial side. We'll also talk about the different vendors and team that you want to put in place and have when you're buying debts, a different story. But the beautiful thing is there's real estate agents, attorneys, servicing companies all across the country to help you with your debt business. We'll talk about some of the different loan trading platforms out there that you can look at assets right now, both residential and commercial, start making offers today, not having to wait a while. And then we'll talk about a lot of other things like marketing. Like I said, there is no dumb questions. I will stick around until all of them are answered. If you go to noteweekend.com, that's the place to get started. That's the place to get registered for you. And all of it's just for $49. And if that's not enough, you better bet your ass we're going to throw in some bonuses for you to help make it an even better class for you. I believe in over-delivering, okay? Under promise and over-deliver, everybody. It's the best thing we do. We definitely do it at our workshop. So what are we throwing in? Obviously, we have the class, normally $99, thrown in for $49. We've got a 4-hour training session called Calling Banks. This is where I'm calling banks for 4 hours. You can see who I'm calling, what I'm saying. You can hear the conversations back and forth. You hear me get hung up on. You hear me having really valuable conversations. People, you see how I leave messages. You see I follow up and track them. Very simple. That's one of the best things. People say this is one of the best trainings because they literally like a fly on the wall looking over my shoulder. And yes, you can ask questions of me live like this. It is recorded, so you get a copy of that, and you attend the next one that we do, just usually a couple days after the Note Weekend class. We will throw in the Bauer financial list. My specific list that I pay for is roughly around $400. We'll send that to you on a quarterly basis there for you. So go through this class, you get the most recent one available that we've downloaded with over 2,000 banks and their numbers, what they're in default on, what they're struggling with. You'll get that included with this as well. You get a 30-minute one-on-one phone call with me after the class to kind of make sure and guide you in the right way. I charge $1,000 an hour for consulting. 30 minutes is $500. The conversation lasts longer than 30 minutes. That's quite all right. My goal is to make sure get you all revved up, but also point you in the right direction. Some people are like, oh, I want to target on this specific class. Like, well, I wouldn't focus in that zip code. I wouldn't focus in that city. I would focus somewhere else just because of the inventory, what's going on in the markets. We'll also throw in a beautiful thing is if you have a spouse or a business partner, we'll throw them in. The replays are included, as I mentioned before, not only the most recent one, but the ones there. So if you got to step out for an hour or two or can't make it on Saturday, you'll get the replays as soon as on Sunday. And then we also got a great Facebook group of about actually over 900 note investors to be a great network for you. Great buying source, a great selling source, a great referral source for vendors, realtors, whatever you might need. Our buddy Cody Cox was buying a couple assets in different parts of the country. He lives in Portland. He jumped on Facebook, found a few people out there to go drive by and pull some comps for him as well in different parts of the country. So he didn't have to jump on a plane or hire an agent to go do a BPO for him. So all this is included, guys and gals. It's over $1,000 in bonuses that we include there for you. I'll throw in one more bonus as well. If you decide or in the class that I didn't deliver on it, you didn't find value on this, I will refund your money back, no questions asked. I'm not making, trust me, I'm not going to get rich on $49 from you guys. But the biggest thing is that's enough skin in the game because free has no value. And I want to train people that I can send deals to as I get lists in from our own marketing. People that I can refer, hey, here's an asset for you. People across the country that have relationships with other people or know a specific market they're going to reach out to. But I want you to know what you're looking at. I don't send deals to people that haven't been through some sort of training. I get people, oh, I want to buy notes. Great. Who have you got any training? No, I'm good. I've been fixing and flipping houses for years. I'm like, well, I'm not going to send it to. Well, I'm a realtor. That doesn't mean anything. But anyway, guys, over $1,000 in bonuses we'll throw in included with it. And all this is just for $49. $49. We make it affordable for everybody. A little bit of investment should be guaranteed that you show up on a Saturday with me, get the replays, get the bonuses, and get rocking and rolling. So I'd love for you guys, no matter what your goal is, we talked about earlier on, whatever your long-term goal is. I know 2020 has been a kick in the shins when it comes to New Year's resolutions, what you want to accomplish, but you can still accomplish so many big things out there. This doesn't have to be a year that we regret. 2020 be a year that we like, wow, we really did take some big strides towards our goals of retiring on the beach, to basically retiring my spouse, putting our kids through college, retiring mom and dad, traveling more, booking some stuff that's cheap, or really booking the vacation of a lifetime on an annual basis, or even upgrading our digs. We've got some people that are using the note business to go find real estate for them to move into. Great deals, great opportunities to take down. Why wouldn't you want to do that? It all takes money, guys, to do this. We'll show you how to raise the capital. We'll show you how to find the deals. And for $49, you'd be off rocking and rolling and be a note investor. So love for you to be a part of it. Go to noteweekend.com. Click on the link that says register here. That will take you to a checkout page. Discounts automatically applied for $49. and start getting an email from us with the link to the bonuses, link to the replay, so you can start learning today and be ready for when the class comes around. So sign up now, guys. I want to open up for any questions, any comments, any concerns from anybody out there that's watching this. I want to thank you for being a part of it. If you are watching this on the replay, whether it is live or catching the replay, feel free to comment. Feel free to mention something. We'll be glad to answer those questions. Myself or my team do a really great job of paying attention to our comments on our videos, Zoom, YouTube, Facebook, whatever it might be. We're here to help answer anything we can for you to help you take your business to a whole new level. So thank you guys for spending roughly about an hour with me tonight on Note Nation Top 40 as we talk about Milwaukee. I think there's a lot of opportunities in that city besides other areas in Wisconsin and all across the country for everybody. So love for you guys to be part of the 1,000 that we're looking to really help change America one distressed debt at a time. So have a great evening, everybody, and we'll see you at the next Note Weekend training.